Well, hi, everyone. Welcome to the third Thursday Themes webinar series. I'm Mark Wade. I'm one of the team members here at CAZ, joined today by Will Van Loo, founder of Quantum Capital here in Houston. Will, thanks so much for joining us.
It's great to be here. Appreciate it.
Well, as we like to start off with, give us a broad overview of yourself, your firm, your strategy, and what themes are you focused on today?
You bet. So first of all, I started the firm 26 years ago in 1998. So we've had a nice quarter century run here. Quantum Capital Group, we're one of the largest and leading providers of private capital to the global energy industry. We focus primarily in the upstream space, upstream and midstream, but we also have a pretty meaningful focus on the energy transition space, and principally within there, renewables, and we even put natural gas-fired power in energy transitions. Also focus on low carbon infrastructure and energy transition and decarbonization technologies. We've got an investment team of about 70 professionals, and that includes more than 30 technical and operating people as part of that 70-person team. And they're supported by roughly another 60 individuals in our fund administration. So about 130 people total here in Houston and in New York. And I think one of the real unique things about our firm relative to a lot of the other players that have been in the space over the last many years is we really do have a very significant component of our investment team made up of technical and operating professionals. And we think that gives us some really unique capabilities and insights in terms of investing capital in the energy space. And we basically invest across not only the various verticals of energy, but we also invest across the capital structure. So we've got pools of capital to do private equity, we've got venture capital, we've got structured capital, which more like mezzanine type capital, and then even some senior credit most recently. And so obviously our flagship fund, original fund was private equities. We've been doing private equity for 26 years, and that does represent the lion's share of the roughly 25 billion of capital that we manage today across those various pools of capital.
Given that breadth across capital structure and different strategies within energy, this question might be a little bit challenging to answer succinctly, but do your best. We always start with the downside of any investment discussion. Anytime we're talking about investing in anything, whether it be energy or other asset classes that we're involved in, it's always about what's the worst case scenario. And so with that in mind, what in your view or in your firm's view is the worst case scenario around maybe pick one of those specific strategies or just a view of the energy space and articulate what that downside looks like? What do you guys focus on when you're talking about the risk side of the equation?
Yeah, so let's talk about oil and gas, since that's the majority of what we do. We're basically buying PDP production today on average at roughly about a PV 15. So that's a discount rate of 15% of future cash flows for what we call proved developed producing or PDP production. And then we're paying very little today for acreage or future drilling locations. And, this contrasts pretty significantly to say the time period, the shales began really in earnest in say 2006 or 7. And so from then through about 2020, the COVID period of time, we were paying PV8 to PV10 for PDP and thousands of dollars per acre, which translated into millions of dollars per location. So kind of said another way is we're buying assets today for 2.5 to 3 times cash flow, as compared to say 5 years ago, we were probably paying double that, 5 to 6 times cash flow. And we buy these assets, obviously we use very little leverage, typically about 1 turn of debt. We hedge commodity prices enough to basically not only get our equity back and pay off the debt, but generally try to at least lock in a high single digit, maybe even a low double digit rate of return on our equity. And what that basically does is that translates into generating mid-teens returns at the portfolio company level without realizing much of any upside from the acquisition that we make. And there's always tremendous upside in those acquisitions. And that's generally today our downside or worst case scenario. And I definitely want to stress that that's not our normal investment environment, right? If you go back over our 26 years, we've seen this environment twice in our 26-year history. This existed from when we started the firm back in 1998 through about 2003. And then again, it kind of reemerged a couple of years ago. So it's a pretty, I hate to say that's the downside, but because we're buying cash flowing assets and we're being able to lock in our future revenues through hedging, we're really able to protect. We've never had any funds that have lost money. We've actually had one fund out of 9 in our 26-year history that didn't generate carry for us, meaning it didn't clear the prep for the LPs. And so that's a good track record, but it's also, if you say this is one of the best times in our 26-year history, the downside is really not much of a downside in today's market.
Certainly sounds like it. Maybe speak specifically to any headwinds you guys are seeing in the sector, maybe not just for you guys, but just for energy broadly speaking, or energy private equity, things that every investor in your space has to encounter and has to overcome.
Yeah, it's interesting. If you think about let me contrast kind of the tailwinds, if you will. Well, we'll get into that. Let's talk. You asked about headwinds, so let's talk about headwinds. I think the biggest headwinds today that we're kind of faced with are the limited capital in our space and the limited people. And by limited capital, what I mean by that is if you go back and you look at the space today, probably 80 to 85% of the private equity that was available, say 5-6 years ago, is no longer available in the space. Public companies really can't even access public equity today. Their access to debt is basically to refi existing debt. And in the bank credit markets, you've probably seen a contraction for private companies, 40 to 50% of the capital that used to be available, in the bank market. So you've got this huge constraining of credit, of capital. And then you couple that with constraining of people, and you go back. Energy is a volatile industry. It's had many ups and downs over the last many decades, a lot of cyclicality to it, and that's caused a lot of professionals to leave the industry to look for more stable sectors. And there's also kind of a misconceived concern around ESG and climate change that affect a lot of young people's desire to come into the industry. And so we're having to do a lot more with a lot less people. And hence our focus on technology and using machines and computers to augment humans to make them more productive. But those are really probably the biggest two headwinds we face today are limited capital, limited people.
Well, you mentioned them a moment ago, tailwinds and things you're excited about. I'd imagine those two things usually go hand in hand together, but talk about that. What's getting you out of bed in the morning right now?
Yeah. So, I think I'll kind of break it down to 3 parts. One of the things you've probably heard me say many times is traditional energy, oil and gas, it's probably the most opportunistic time to invest in the space in several decades. And I think there's kind of 3 reasons or 3 tailwinds, for me saying that. I think first of all, we've seen a significant underinvestment globally over the last decade to replace produced oil and gas reserves. And then coupled with capital constraints created by discipline that's been forced upon public companies by their shareholders, basically wanting them to reinvest only 30 to 50% of their cash flow and send the other 50 to 70% home through share buybacks and dividends. And so this capital constraint, if you will, is really starting to constrain oil and gas supply. And then when you couple that with demand growth that's going to happen over the next several decades from a global population that'll grow roughly between now and 2050 by about 2 billion people, and you're going to move another billion people from basically the low income to middle income class globally. And then you're going to add on top of that, this massive growth we're seeing in energy demand from things like data centers and AI.
Hmm.
And all of a sudden, you step back and you look at that and you say, from a macro perspective, we've got one of the most favorable oil and gas supply and demand dynamics we've seen in several decades. And I think this will have a very favorable implication for future commodity prices. So that's kind of the first part of the tailwind, if you will. The second part really just has to do with valuation. Um, Oil and gas is one of the cheapest, maybe the cheapest asset class in the world at scale today. Um, in terms of how these assets are pricing. If you look at the average public company, oil and gas company, it trades for about 5 times forward cash flow. And you look at the average S&P company in the S&P, it's about 12 times. So, almost a 2/3 discount in multiple. Privately, there's another couple of turns of discount. So private assets today are selling at 2.5 to 3 times cash flow. There's no other asset in the world you can buy, cash flowing asset you can buy at 2.5 to 3 times cash flow. So the second kind of tailwind, if you will, is cheap, super cheap buying valuations. And then third, when we look around at kind of the competition out there, other capital providers, if you will, and you look at the number of players or the availability, just the dry powder, say private equity dry powder. 5 or 6 years ago, that was probably 90 billion, $100 billion. Today, it's about 15, maybe 20 billion. So it's down around 80 to 85% just over the last 5 or 6 years. So you've got massive capital constraint, you've got unbelievably cheap valuations, and you've got limited competition. And in boot with, oil and gas is probably one of the most positively correlated asset classes when it comes to inflation. And that's something, we haven't talked a lot about the last 20 years until the last couple of years. But I do think it's one of those attributes of oil and gas that kind of literally got forgotten for a couple of decades, is that during inflationary periods of time, oil and gas typically is one of the best performing asset classes, industries, globally. And so, you kind of put all that together, and for us, when we look at the investable landscape out there globally across all asset classes, energy kind of pencils out is really has tremendous tailwinds behind it. And these are tailwinds that, they're not going to, the energy cycles, it takes, a decade to kind of change supply demand dynamics. And so that for us is it's a tailwind with a lot of wind in the sail.
Yeah, when I hear fundamentals of an industry that have, effectively never been better or is as good as it's ever been, and I hear valuations are as cheap as they've been in a very long time, that third piece of the puzzle you talked about, that's the one that doesn't make sense, right? Like anybody who sort of studied markets knows that where there's strong fundamentals and that there's excessive profits to be earned, capital flows, right? Money chases good returns. But you're telling me that the money's going the opposite direction. I want to maybe double click on that. Why do you think that is? Like, what are people missing? What are people going to be surprised about? Maybe that they're not fully baking into their analysis. Why is this happening?
Yeah, so I think there's two reasons why people are missing it, or people are not flocking to the space, because you're exactly right. I mean, typically, anytime you have an arbitrage opportunity exist in capitalism, it typically pretty quickly gets arbed away, right? Because money will flow in, and that valuation discrepancy gets arbed away. I think there's two big things that are kind of creating a significant constriction or hesitancy, if you will, for people to put capital in space. I think the first is, if you go back from like 2010 to 2020, that decade, most institutional investors, most high net worth families that invested in oil and gas didn't do that well, whether they were public or private. The returns during that decade, during that first real decade of the shale revolution, they were really poor. Public companies averaged low single-digit return on capital employed. Many private equity firms didn't even return capital for several of their funds, series of funds that they raised. And so you had a lot of pain in the sector because people lost money. there was really only a handful of private equity firms like Quantum that did not lose money during that period of time. So for a lot of it, it's just, wow, I was burned in the space. I'm going to very carefully think about going back in. I'm going to have to be convinced that the space has changed, that something's changed about it. That takes time. And I think the second thing is, I think people are, um, all the talk that's been going on over the last 3 or 4 years around climate change and ESG. Are we even going to be using oil and gas in 5 or 10 years? You know, for people that truly understand how the energy system works, and that, energy transitions are really more energy additions. Like, we've never transitioned from any form of energy in the history of the world. We use more of all forms of energy today than we've ever used, including coal. Um, you know, People that understand that will understand that's not something you should be concerned about. But I think there's been so much rhetoric in the press that's just, quite frankly, scared people.
Mm.
That, just the unknowns of what the market will be like, what demand will be like. Is wind and solar going to negate the need for oil and gas and coal and all this? And so I think just those two factors have contributed, because they both kind of existed at the same time. I think they've contributed to, a lot of investors across this country and across the globe just being very cautious about, jumping back into oil and gas, even though we've now had 3 or 4 years of pretty good returns, both in the public and the private markets.
Well, what do you think is going to surprise people then about, the next 3 to 5 years in light of those, considerations?
Um, let's step back and kind of say, today, how are we underwriting deals? A typical deal that we would underwrite in oil and gas today, we're probably underwriting kind of a base return of 2.5 to 3 times our money, and a 25 to 35% kind of net rate of return. Um, I think what'll surprise people, if the macro environment plays out like we think it could, and that just being that, this massive underinvestment we've had. If you go back since 2014, we've on average invested globally about $425 billion in finding new oil and gas resource every year. Okay. That's been an underinvestment of about 50%. It needed to be about double that. And that's compounded now for a decade. And so, in our minds, that massive underinvestment, you don't turn it around in a year or two. It takes a decade or more to double down and start finding those new resources. And so I think a combination of that, and a combination of, as China and India continue to grow their economies, huge demand for energy. If those macro things play out, I think what we could see is a pretty significant movement in prices. And if you go back to the decade of the kind of March of 1999 to July of 2008, during that roughly decade, where we had a lot of the decade of the 1990s, we had meaningful underinvestment. Okay. It was the first time since World War II that we didn't replace, as a globe, the oil and gas reserves that we produced. Okay. We only replaced about 60% of what we produced that decade. That set up over that decade from 99 to 08. That set up a 15-fold increase in oil prices. They went from $10 to $150 roughly. And gas prices went from about $1.50 in MMBTU to about almost $15. So about a 10-fold increase. Not saying we're going to have that. But even if just commodity prices double over the next 5 years from where they are today, the returns that you'd be looking at would be materially higher in these funds. So you've got great downside protection. And through, cash flow, you get your cash flow back relatively quickly. And yet you've got, given the macro environment, how it looks to be set up, for the first time in probably 15 to 20 years, we believe that there's a much higher than average probability that we'll have a nice increase in commodity prices. And so
Are
I
you,
think that's the one thing that could really surprise people to the upside.
so you're telling me that you think supply and demand is still a real thing and factors prices in markets?
I still think that's a real thing.
There you
And
go. Indeed.
so, yeah.
Well, I'll leave you with this. On a scale, we like to do things here 1 to 7, 1 being the worst, 7 being the best. What is, your current view of the risk reward in your space right now? I think I know the answer, or at least I don't want to speak for you, but in your word, put a number to it. 1 to 7, 7 being the best, 1 being the worst.
Well, I'll never give something a perfect score, so I'm not going to give it a 7, but I'm going to give it a 6.5. And like I said a minute ago, the only other time in my career, I've been in oil and gas now for 33 years, that I've seen in investment environments anything close to this was kind of back in the very late 90s and very early 2000s. So it's been 20 years since we've seen these kind of opportunities and these kind of risk-adjusted returns being presented to us. So that in my scaling gets about a 6.5.
I like it. Well, thank you, Will. Appreciate the time very much. Very grateful for the partnership. Thank you for
You
joining
bet.
us.
Thanks for having me on. Appreciate it.